Uh, Good day, participants of the 27th International Conference of Pacific Rim Management. I am John Francis Diaz of the Chungyan Christian University. Today I'll be presenting a paper which was co-authored with my master student named Mr. Tong Trong Tin. He is Vietnamese, just in case you were wondering. I am a Filipino, by the way. And the title of this paper is Determinants of Banks' Capital Structure, Evidence from Vietnamese Commercial Banks. So for the first section, I'll be briefly introducing the paper. I'll be giving you the overview, the motivations, and the objectives of this paper. Basically, this research investigates the important factors influencing capital structure decisions. The study focuses on the degree of leverage of 31 Vietnamese commercial banks from 2009 to 2014. Because banks in Vietnam right now play a key role in the growing economy of the country, this research is very much relevant. This study examines 5 bank-specific factors, that is your size, profitability, growth rate, taxation, and tax rates, and business risks. And we are also considering 3 financial market and economic variables, namely your stock market condition, economy, and inflation. So these factors will be studied if they have an influence or effect on capital structure, wherein debt ratio will be used as a proxy dependent variable. The analysis employs and compares multiple linear panel regression models, namely ordinary least squares or OLS, and fixed effects and random effects models, or FE and RE respectively. There are 3 main types of commercial banks in Vietnam. The first one is your state-owned, the second one is the joint stock, and the third group of banks will be having the joint venture banks, foreign-owned banks, foreign banks branches in Vietnam they will be grouped together. Among these banks, state-owned banks are the biggest. As you can see on the table, only 5 state-owned banks have a total asset of $134.5 billion. Compare that with the joint stack banks, wherein 33 banks have already a combined asset of $130 billion. All in all, there are 46 commercial banks in Vietnam as of this study date, which concluded in 2015. This research is motivated by the lack of empirical literature in determining the factors that affect the capital structure of Vietnam's banking industry, with particular focus on the bank leverage, or the capital structure, or the debt ratio. This paper augments the literature by dividing samples into 3 major categories based on their charted capital. Namely, these are your large capitalization banks, wherein in this study, 8 banks have a capital greater than $468 million. Medium capitalization banks, wherein in this study, we have 11 banks with chartered capital from $234 million to $466 million. And lastly, we have your small capitalization banks. In this study, we have 12 banks with chartered capital less than $234 million. The general objective of this research is to identify significant determinants of capital structure in Vietnam's banking industry. And the 3 specific objectives are to examine the degree of relationship, be it positive or negative relationship, between bank's debt ratio and the chosen internal and external determinants, and to identify which factors, from firm-specific to economic factors, have a stronger influence based on the outcome of the coefficients. And the last objective is to determine if there are differences on the significant factors determining the leverage, as can be seen from the capital structure of large, medium, and small capitalization banks. These studies' objectives are of significant interest because identifying factors influencing Vietnamese banks' capital structure can provide insights to bank decision makers and corporate research divisions. Given the paper's futures findings, responsible parties inside the bank are able to monitor and even control relevant firm-specific and macroeconomic factors to create timely and beneficial financial decisions. So for the second section, I'll be briefly discussing the literature review and related hypotheses. And as mentioned earlier, this study considered 5 bank-specific factors and 3 financial market and economic variables. So the first variable is size is measured in terms of total assets. From this definition, we can conclude that the more assets a firm owns, the bigger its size is. According to the bankruptcy cost theory, firms with large size tend to borrow more debts than small ones because of having easier access to capital markets. This claim was also supported by the study of Strebullev and Korshev of 2006. Hence, this paper hypothesizes that size and leverage are positively related. The next variable is profitability. The profitability in this paper directly measures the performance of firms and is defined as the money that company makes after accounting for all the expenses and taxes. Thus, this paper considers the value of banks' net income to measure profitability. Aramo et al. 2013 used the pecking order theory to explain that profitable firms prefer internal financing. Thus, profitable firms tend to retain more profit for expansion instead of servicing debt, which makes the relationship negatively related. For this paper, we will assume that profitability and debt have inverse relation. Now, let's have growth rate. Growth rate measures the potential of firms to expand their business in the future or the investment opportunities that a firm can foresee. In this paper, growth rate is measured using the market value of the firm over its book value, over the book value of its total assets. Based on the explanation of Chen and Zhao of 2006, they explained that when firms see good opportunities in the future, they demand more capital for investment, and firms prefer debt over the issuance of stock, thus making the relationship of growth and leverage positive. Tax rates, on the other hand, are compulsory contribution levied by the local government, are applied to all firms, and also play an important role in capital structure decision. Firms with high degree of leverage can get much benefit from tax shield because interest on debt is a tax-deductible expense. The study of McKinley 2013 provided evidence that the marginal tax rate positively affects financing decision. So the next variable is business risk. Business risk is the possibility of inadequate profits or even losses due to market uncertainties like changes in preferences of customers, employee strikes, increased competition, obsolescence, and even changes in government policy, which immediately affects earnings before interest and taxes, or EBIT. The study of Titman and Vessels in 1988 explained that with less stable earnings, firms bear higher bankruptcy costs, thus they refuse to add more debt. Therefore, business risk is, this study thinks that business risk is negatively related with incurring more debt. The next variable is stock market condition. Stock market condition refers to returns on the stock prices using a stock index, which affects the overall market valuation of firms. The relationship between stock market condition and leverage is explained by the market timing theory. Frank and Goyal, 2009, showed that firms issue equity, which means less of debt, when their market valuations are high, which negatively affects leverage. Economic condition is, economic condition on the other hand is the general state of the economy and will be measured by the annual percentage of Vietnam's GDP. In boom economy, most firms profit because most firms have increasing revenues and increasing profit because these elements, both of these elements go up, and firms will prefer internal sources like retained earnings over debt during expansions. This was confirmed by the empirical studies of Disser-Gok and Yeltsin in 2011, stating the negative relationship between economic conditions and the level of debt. Inflation, on the other hand, directly affects the cost of debt based on the market timing theory as explained in the study of Frank and Goyal in 2009, suggesting that firms expecting increase in the inflation rate with an expected increase in the inflation rate, firms decide to employ more debt because firms realize that the present cost of debt is cheaper. So that summarizes the literature review that this study used to justify its hypothesis. For the third section, I'll now be briefly discussing the data and methodology. Like what I've said earlier, this research paper focuses on the Vietnamese banking industry, particularly local commercial banks. Currently, there are 46 commercial banks operating in Vietnam. However, due to some data limitations, this paper will only consider a panel of yearly data consisting 31 banks from 2009 to 2014. Dependent and independent variables will be primarily based on the audited financial statements of banks collected from Vietstock Finance website, while macroeconomic data like GDP and inflation are collected from Trading Economics website. The analysis employs multiple linear panel regression models, and namely they are your OLS, fixed effects model, and random effects models. There are 8 determinants to be tested, including 5 bank-specific factors like size, profits, growth rate, tax rate, and business risk, and 3 economic and financial market variables like stock market condition, economic condition, and inflation. These variables are tested against bank leverage. Hausman test will also identify the better model between FE and RE models, while the highest log likelihood value will determine the best fitting model among these 3 methodologies. Now let's go to the empirical results section of this paper, which is the 4th section. So let me warn you, this is a bit longer, so don't get bored and pretend to listen. This study initially tabulated the correlation matrix to check for correlation problems. If the correlation value is equal or larger than 0.8, the study will remove 1 or more variables if necessary. For this study, risk and growth rate have a consistent correlation problems. Thus, this study removed these factors for the final regression models. Now, this table illustrates the regression results for large-sized Vietnamese banks. using the models that were mentioned earlier. The Hausman test prefers the RE model over the FE model because of the insignificant p-value. However, in comparing the results of the OLS and RE models, the value of the log likelihood favors the OLS model over the RE model. So thus, we'll be concentrating on the OLS results. So for this table, just look at the results with red fonts. So by the way, for the simplicity of this presentation, we will be only analyzing the model that was selected by the log likelihood value. But in the paper itself, the research paper itself, the authors interpreted all of the results. So in this particular table, the size variable is positively related with debt ratio. This implies that bigger total assets of banks lead to higher debt ratio. This result is consistent with the findings of the earlier studies of Vatavu in 2012 and Strebuliev and Korshev in 2006. For the recommendation, the study suggests that large banks capitalize on their market network to attract more depositors and easily get loans from interbank sources or from the government with lower interest. On the other hand, the profitability variable for large banks has negative effects on leverage. This finding is consistent with the pecking order theory and related to the research of Arimu et al. In 2013, saying that profitable banks have less debt ratio. Following this concept, it is suggested that large Vietnamese banks with higher profit continue to use internal capital in the form of retained earnings and additional equity if they can, to minimize borrowing from external sources. This table, the next table, illustrates three regression models. Again, the Hausman test prefers the RE model over the FE model because of the insignificant p-value. But in comparing the results of the OLS and RE models, this paper again favors the findings of the OLS model as the better fitting model for medium-sized Vietnamese commercial banks. This is because the RE model has a lower log likelihood value, or the OLS model has the higher log likelihood value. The size factor is again positively related with the leverage ratio of medium-sized banks, which is consistent with the explanations of Vatavu in 2012 and Strebuliev and Korshev in 2006. The study suggests that medium-sized Vietnamese banks should attract more depositors and use lower interest loans whenever necessary for quicker expansions. This is because medium-sized banks sometimes are ignored by the equity markets for reasons of instability and unproven track records, unlike their bigger counterparts. For small-sized banks, this table shows that the Hausman test and log likelihood value prefer the RE model over the FE model and OLS model respectively. The size factor for small-sized Vietnamese banks is again positively related with the leverage or debt ratio, or leverage ratio. This result is in accordance with the earlier studies of Vatavu and Strebuliev and Korshev. However, this paper posits that one of the reasons why small-sized Vietnamese banks also have higher leverage because, like their medium-sized counterparts, small banks are commonly ignored by investors in the equity markets for reasons of illiquidity and instability in their operations, pushing them to rely on attracting more depositors if they can and borrow funds even to the point of experiencing relatively higher interests. The regression coefficient of growth rate variable is negative under the RE model. which do not conform to the paper's hypothesis. However, this finding is again in accordance with the agency cost theory and the studies of Barclay et al. 2006 and Pandey 2001, explaining that companies prefer using their own capital over funds coming from debtors. This is particularly true for small Vietnamese banks because it is riskier for them to borrow compared to the more stable, large and medium-sized banks because of lower total assets and higher interest payments that will be charged to the smaller banks. So it is suggested then that small banks can also try tapping over-the-counter markets for equity issuance to fulfill their needs for external capital or pursue their investment choices and also diminish the risk of bankruptcy. A negative coefficient for the economic condition variable was also observed, which means that small Vietnamese banks' leverage is inversely affected by economic condition. This finding is in line with the prediction of the paper and also follows the explanations of Frank and Goyal and Welch of 2004. These studies concluded that in a good economic condition, most firms, including small banks, get higher than usual profits and they prefer using internal source of financing instead of borrowing from external sources, which is actually more costly for small Vietnamese banks. This paper suggests then that in booming economic conditions, small banks should exploit these boom times through aggressive marketing of products and expanding operations to take advantage of general economic liquidity. And if they have a chance of borrowing lower than usual interest, small banks can also obtain a small and manageable amount of debt in times of economic booms. So those are the specific results of the study. For the last part, I'll be providing you with the conclusions and the limitations of this paper. So generally, the findings of this paper is in line with previous empirical evidences. Bank size has been the most consistent variable affecting leverage in all the bank groups. The findings lead to the belief that the bigger banks have higher leverage, and this can be attributed to the advantage of having a stable reputation and a larger network, making them have easier access to external capital, including debt on selected occasions. On the other hand, medium and small capitalization banks' leverage mostly comes from depositors instead of debtors because they're not so consistent. They are not so consistent in terms of their liquidity and stability in their operations. Profitability, on the other hand, has significant negative impact on large bank groups' leverage, suggesting that large Vietnamese banks prefer using internal source of financing or your retained earnings. Furthermore, growth rate shows negative impact on small bank groups, assuming that small Vietnamese banks mostly use their profit for their investment rather than borrow funds from external sources, which actually supports the pecking order theory. On one hand, economic conditions also have important influence on small-sized banks group. In economic booms, small banks get more profit than usual, so they can utilize these profits for future investments because this is the cheapest way to source capital. Moreover, with the chance of accessing low-interest capital in good economic condition, small banks can seize this opportunity to absorb a controllable amount of debt to increase their profit. So although the study provides a considerable amount of contributions, there still exists some limitations and suggested future studies to be improved in the next researches. First, the study did not cover all of the Vietnamese banks in Vietnam. because some banks do not disclose their full financial statements. Also, the Vietnamese banking industry has just developed in recent years, and these are the reasons why the study period is relatively short to fully cover the overall development of the Vietnamese banking industry. So, future studies are suggested to increase the data span and cover additional banks not included in the study. Second, M&A activities have been an increasing trend in the Vietnamese banking industry. So it is recommended that future researchers particularly focus on banks who underwent mergers and acquisitions. Third, most of Vietnamese banks are still not publicly listed. Future studies can try investigating the factors affecting the leverage and possibly even the profitability of private banks and family-controlled banks. Moreover, prospective research can also extend the number of significant determinants, that is, ratios related to cash conversion cycles, for example, to find out which factor is significantly important to determine Vietnamese banks' capital structure. But regardless of these limitations, this paper can still be considered as a pioneer in investigating the capital structure of Vietnamese commercial banks. And this paper also provides a good perspective to the banking industry. The paper is also helpful for Vietnamese academics and researchers and bank managers who want to study factors affecting banks' capital structure for their future researches and in making capital structure decisions. So that's it. Thank you for listening, and I'll be welcoming now some questions, suggestions, and comments. Thank you very much. So by the way, this is me and my former master student advising.